Good morning, everyone. How are you? Welcome back to my YouTube channel. This is video 7th of my mutual fund series, and today the topic is the debt funds and what are the types of debt funds and what part they play in the strategies of asset allocation and diversification. So debt funds are also called as fixed income funds because of their fixed component which is associated with these debt papers, which you can call as coupon, which is the fixed return, fixed interest out of these sum of these debt papers which is out there in the market. So what is debt funds? So debt fund is basically a loan which is created by big corporates and also can be created by small corporates too, and the government institution for their financing, and the general public can buy it from the securities market, and it can also be bought as a portfolio from mutual fund managers, which I am about to discuss. So mutual fund industry is about 75 lakh crores, so out of which 35 lakh crores is the size of debt mutual funds. So these debt mutual funds are very pertinent component of any portfolio, and it is used by many corporates and ultra HNS to park their surplus amounts and for diversification purposes too. So debt funds are generally categorized as the duration of papers which is out there in the market, or the quality of papers they are investing in. So first I will describe the duration one categorization, and the first two names which come is aggressively used by corporates to park their surplus capital and the working capital they need in shorter duration. So the first is overnight fund, which has the duration of papers of only 1 day, and its papers matures in 1 day, and the fund manager buys other new papers in next day. That's how they are created. It's very less volatile as compared to other debt funds also, though debt funds are very much very less volatile as compared to equity fund, but still there is some mark to market impact out of there which is in the market. So the second category I would discuss is the liquid fund, which invests around 45 days of maturity. So they invest in papers which have generally duration of 45 days. So the third one is ultra short term fund, which invests in 3 to 6 months of paper. Then the money market fund, which invests in under 1 year duration of paper. Then the low duration, which invests in 3 to 6 to 12 years of paper, 6 to 12 months of paper. I will briefly discuss about the duration, and you can select these fund according to the duration you are comfortable with. Then comes the short-term debt fund, which is 1 to 3 years of paper. Then medium term, which is around 3 to 7 years of paper. Then the longer duration funds, which invest in more than 7 years of maturity papers, and you can select these mutual fund according to the macros of the economy, whether its interest rate is increasing or decreasing can be used to select these debt funds, and according to a set allocation also you can use it. Many ultra HNS use it as a set allocation part to somehow negate the volatility which is sometimes can be there in the market, and nowadays also there is a volatility. So debt funds are regularly used for those, and diversification part also it can be used. So if a person is of later age of investing, you can say he or she is in 60 years of age. So I generally recommend 35% of debt allocation on in these portfolios. So these are used as a these can be used as a diversification strategy too. So the next categorization I would like to discuss is the quality of paper which these debt funds invest. For example, is banking and PSUs, credit risk debt funds, and gilt funds. So these are the types which includes the quality. So corporate bonds is invested in only corporate bonds. It can be a varied quality basically, and banking and PSU is invest in banking and PSU funds papers only. Then the credit risk fund invest in more than 65% of their assets in more than AA rated papers. These ratings are given by rating agencies according to the balance sheet of the companies which are floating these debt papers. So the other fund is the gilt fund, which invests more than 65% of their portfolio in 10-year GSEC, which is floated by the government for their financing purposes. So these are the types of debt funds, and they can be used as a part of the asset allocation and diversification strategy. So somehow this is a brief description, and I would only like to ascertain and discuss a small briefing about debt fund. That is why I'm including these videos. And if you have any suggestion or feedback out there, you can comment on the comment section or give me a feedback. So thank you so much for watching these videos, and continue watching these videos. So thank you so much, guys. I really appreciate it.